Hello finance enthusiasts, and welcome back to your go-to channel, Today's Finance News. Today, we have 3 jam-packed updates about United States finance that hit the headlines just a few hours ago. If you are a true finance enthusiast, you absolutely do not want to miss these massive market shifts. Before we dive into the deep end of today's financial data, I have a quick request for you. If you are new to the channel, please do not forget to like this video and subscribe to our channel so that you can stay completely in the loop with every single update. We have some incredibly fresh, raw data coming straight from the markets today, covering everything from regulatory turnarounds to massive corporate shifts. Let us jump straight into our first major headline, which is tracking a massive corporate comeback story that is shaking up the alternative asset sector. Update 1. From federal raids to the New York Stock Exchange, the incredible financial resurgence of Glass House Brands. Our first major update follows a company that has experienced the absolute lowest and highest points in its entire corporate history over the past year. Glass House Brands, the absolute biggest cannabis grower in Ventura County, is navigating a wildly volatile financial landscape driven entirely by decisions made in Washington, D.C. Exactly 1 year ago, on July 10, 2025, federal agents executed a massive raid on the company's cannabis greenhouses located across Ventura and Santa Barbara counties. This action stood out as one of the single largest raids witnessed during President Donald Trump's second-term immigration crackdown. The immediate financial and operational fallout was catastrophic. Hundreds of workers were arrested, and tragic operational disruptions occurred, including the death of a worker named Jamie Alanis Garcia, whose family has since filed lawsuits against both the federal government and Glass House Brands. In the wake of this enforcement action, Glass House Brands saw its entire greenhouse labor force vanish overnight. The corporation was forced to completely rebuild its workforce from scratch, while fundamentally restructuring its internal procedures for vetting both direct employees and outside independent contractors. State regulators stepped in as well, issuing a $21,000 fine against the company for insufficient record-keeping regarding the ages of its workers, after federal officials discovered approximately a dozen underage workers at the Camarillo facility. While California law permits individuals as young as 14 years old to work in traditional agriculture, the legal threshold for the cannabis industry is strictly set at 21 years of age or older. From a pure balance sheet perspective, the disruption drained millions of dollars out of the company. A severe shortage of physical laborers caused total revenue for 2025 to plummet by 10% compared to the prior fiscal year. The single quarter in which the raids occurred saw a staggering 40% year-over-year decline in revenue. To put this in perspective, Glass House Brands was narrowly profitable in 2024, but for the full year of 2025, the company reported a massive net loss of nearly $30 million. This corporate downturn sent shockwaves through the local government's coffers as well. Because Glass House Brands is the dominant agricultural cultivator in the region, Ventura County's total tax revenue derived from cannabis cultivation dropped by 23% for the 2025 to 2026 fiscal year, which wrapped up on June 30th. The county's total cultivation tax revenue finished at just $4.9 million. During a recent conference call with Wall Street analysts and institutional investors, Chief Executive Officer Kyle Kazan openly admitted that the firm is still actively recovering from the operational shockwave. The company has been forced to lower its forward-looking earnings guidance for 2026 due to unexpectedly high production costs. Chief Executive Officer Kazan noted that operating with a less experienced workforce supplied by third-party labor contractors has severely hindered overall industrial productivity. Company founder and president Graham Farrar even compared the recovery to a world-class marathon runner trying to compete with 2 broken legs. However, the narrative has completely flipped into a massive financial triumph due to an entirely separate shift in federal policy. In April, the Trump administration officially eased federal prohibitions by moving medical marijuana from Schedule 1 to Schedule 3 under the United States Drug Enforcement Administration's classification framework. This massive regulatory shift completely altered the company's financial destiny. Under the old Schedule 1 status, major United States stock exchanges refused to list cannabis businesses, forcing Glass House Brands to trade exclusively on a Canadian stock exchange. To capitalize on the federal reclassification, executives swiftly spun off their recreational retail division into a separate, privately held entity. This strategic corporate restructuring allowed the core wholesale and cultivation business to successfully list directly on the New York Stock Exchange. On June 30th, Glass House Brands officially commenced trading on the New York Stock Exchange, the second largest equities market on the planet. While the stock price has experienced minor post-listing stabilization, closing at $11.81 on July 10th after an initial 5% pop to $13, the underlying market sentiment is incredibly bullish. In fact, when President Trump initially signed the executive order directing the Drug Enforcement Administration to reschedule the asset class, the stock instantly skyrocketed by 60% in a single trading session, ultimately doubling in value over a 4-month span. Market analysts note that Glass House Brands is only the second cannabis corporation in history to successfully bridge the gap to a major United States stock exchange. With a massive 5.5 million square feet of greenhouse space under glass at their Camarillo complex, they now possess the largest facility of its kind in the world, perfectly positioning them to secure export permits from the Drug Enforcement Administration for international distribution into lucrative markets like Germany. Update 2. The aerospace supercycle boom. Is this high-flying titan fast approaching a valuation ceiling? Moving right along to our second massive update for today's finance audience, we are breaking down a major industrial stock that is currently sitting directly under the Wall Street microscope. ATI Incorporated, formerly known as Allegheny Technologies Incorporated, is back in sharp focus after a massive insider transaction caught the attention of institutional investors and individual shareholders alike. The company's chief executive officer, Kimberly A. Fields, has officially executed a major liquidation, selling 40,000 shares of stock under a pre-planned Rule 10b5-1 trading plan, with all transactions officially finalized on July 7, 2026. When an elite executive unloads a significant block of equity, the immediate question on every trader's mind is simple: has the stock officially topped out? Let us break down the exact performance numbers and the core fundamentals to see what is really happening behind the scenes. At a current market share price of $187.04, the equity has eased back slightly in the very short term. However, if we look at the broader macro timeline, the momentum is nothing short of breathtaking. ATI Incorporated has delivered a highly impressive 90-day share price return of 15.31%. Even more staggering is the long-term track record. The company has generated a massive 5-year total shareholder return of roughly 8 times, pointing to incredibly powerful long-run upward momentum that this recent insider selling is now sitting directly against. Because the stock has delivered such powerful multi-year gains and pushed into a fresh leg higher right before this insider liquidation, the next crucial step for any disciplined investor is to rigorously test the current valuation. We need to analyze whether the vast majority of the future upside has already been fully priced into the equity. Currently, the most popular consensus narrative among Wall Street analysts indicates that the stock is hovering at approximately 1% overvalued. ATI Incorporated is trading at that $187.04 mark against a highly scrutinized, most followed fair value estimate of $185.56. This means the prevailing market narrative has priced the stock slightly ahead of its core mathematical model, even though the broader investment thesis still leans heavily on a deeply detailed, long-term earnings and cash flow story. So, what exactly is driving this high valuation narrative? And why are investors paying such a massive premium for this industrial asset? The primary catalyst is a series of massive long-term contract expansions that ATI Incorporated has secured with the absolute giants of the global aviation sector, Boeing and Airbus. These sweeping commercial agreements include brand new titanium alloy sheet supply deals and significantly broader product offerings across the board. Strategically, these contracts lock in massively higher production volumes and strict procurement minimums, effectively expanding ATI Incorporated's overall market share. Crucially for the bottom line, these multi-year contracts feature robust inflation pass-through clauses and highly attractive structural pricing. This directly supports reliable, higher-margin revenue growth and establishes a structurally improved corporate earnings base that is designed to last entirely through the decade. The bullish investment thesis relies on these compounded revenue gains, steadily rising profit margins, and a projected future profit multiple that stands significantly above many of its traditional industrial manufacturing peers. However, the financial picture is not entirely without risk, and smart money is preaching caution. Bearish analysts point out that ATI Incorporated maintains a very heavy operational reliance on just a few large aerospace customers, which creates a concentrated revenue stream. Furthermore, the company is facing ongoing, intensely high capital spending requirements to maintain its manufacturing capacity. If global macroeconomic conditions shift, or if supply chain disruptions hit the commercial aviation sector, these heavy structural costs could quickly challenge the current fair value narrative and pressure the stock. Update 3. The $325 million space windfall. How Wall Street magnates are fueling a financial revolution for American children. Now, let us bring it all home with our third and final massive update, which is absolutely dominating the headlines right now. We are witnessing a historic intersection of massive aerospace wealth, corporate philanthropy, and national financial policy. President Donald Trump has officially taken to social media to express his profound gratitude to Space Exploration Technologies Corporation President Gwynne Shotwell and her husband, Robert Shotwell, following a historic, jaw-dropping donation of $325 million worth of private SpaceX equity. Late Wednesday, President Trump posted a dedicated statement on Truth Social to publicly acknowledge the Shotwells' massive contribution. He highly praised the couple's extreme generosity and emphasized the life-changing positive impact this specific donation will have on thousands of young Americans striving to achieve the American dream. So, how exactly does this massive financial mechanism work? The president's public recognition came immediately after Gwynne Shotwell announced that she and her husband would be transferring $325 million in SpaceX shares directly into the highly publicized Trump Accounts program. This massive gift is explicitly earmarked to benefit more than 2 million American children. The program specifically targets young adolescents aged 11 to 17 who come directly from lower-income households, with a very heavy, intentional geographic focus on families living near the Shotwells' Central Texas operations base. The Shotwells' massive equity donation is executed as a core part of the broader Invest America initiative, a nationwide program designed to provide a rock-solid financial foundation for children in need. Under the structural rules of the program, these donated funds are automatically deployed into a low-cost, diversified Standard & Poor's 500 index fund. This ensures that the capital grows alongside the broader United States economy. Furthermore, the accounts are structurally flexible, allowing additional matching contributions to be made by families, corporate employers, and other private parties, up to a maximum threshold of $5,000 annually. President Trump's public praise of the Shotwells also included a strong note of confidence regarding Space Exploration Technologies Corporation Chief Executive Officer Elon Musk. The president expressed immense confidence that Elon Musk might soon follow suit and donate a massive block of his own SpaceX equity to help scale the program even further, underscoring the incredibly strong, collaborative relationship between the administration and the tech billionaire, despite past public disagreements over federal electric vehicle mandates. This massive $325 million injection officially adds Gwynne Shotwell to an elite, rapidly expanding roster of ultra-wealthy Wall Street and technology titans backing the Trump Accounts initiative. To put the scale of this program into perspective, Michael and Susan Dell of Dell Technologies Incorporated previously pledged a staggering $6.25 billion to seed 25 million children with $250 each. Similarly, billionaire hedge fund founder Ray Dalio and his wife Barbara committed at least $75 million to fund over 300,000 children across Connecticut. Ray Dalio has publicly championed the program, noting that it serves as an unparalleled educational tool to teach the younger generation about the core mechanics of personal finance, long-term investing, and free market capitalism. According to the latest operational data released by Robinhood Markets Incorporated Chief Executive Officer Vlad Tenev, the explosive growth of the Trump Accounts platform has completely outpaced the early adoption metrics of many of America's absolute most successful technology giants. As of June, nearly 6 million American children have already been successfully enrolled in the program, signaling a massive paradigm shift in how early-stage wealth building is handled in the United States. What an absolute roller coaster of financial updates today. From glasshouse brands fighting its way through federal raids to secure a premier spot on the New York Stock Exchange, to ATI Incorporated testing the absolute upper limits of its aerospace valuation, and finally, SpaceX leadership pouring $325 million into the future of American wealth building. The financial landscape is moving faster than ever before. And if you want to protect your capital and spot these massive macroeconomic trends before the rest of the crowd, you need to stay locked in. Thank you so much for tuning in to today's finance news. Make sure to smash that like button, hit subscribe, turn on all notifications, and drop a comment down below letting us know which of these 3 updates surprised you the most. Stay smart, stay invested, and we will see you in the very next video.